Welcome to the Deep Dive. Today we're really digging into the third quarter 2025 results for Bank of America. They dropped on October 15th and made quite a bit of noise. Yeah, you probably saw the headlines, those big growth numbers. But our mission here isn't just reading the numbers back. We want to get underneath them, understand the drivers, like where did this profit actually come from? Is this kind of growth sustainable? And what does it tell us about the bigger picture?
Well, the top line numbers certainly looked impressive. Net income jumped to $8.5 billion. That's up 23% compared to last year.
23%, wow.
Exactly. And diluted EPS, earnings per share, shot up 31% to $1.06. Total revenue came in around $28.1 billion, which is up 11% year over year. Pretty strong stuff. But I think the really interesting part for you, the listener, is how they managed that profit growth. They showed 5.6% positive operating leverage.
Right, meaning revenue grew way faster than costs.
Precisely. And that flowed right through to the efficiency ratio. It improved quite a bit, down to 62%. Remember, it was 65% this time last year.
Okay, shaving off 3 points while growing revenue like that, that's pretty effective management. So let's talk about the core engine, right? Net interest income, NII.
Yep, the bread and butter. The money they make on loans minus what they pay out on deposits, especially important now with rates where they are.
So how does that look?
Very solid. NII was $15.2 billion. Now, you might see $15.4 billion mentioned. That's the fully taxable equivalent figure, or FTE.
Ah, right, the standard adjustment for comparing banks.
Exactly. It just levels the playing field, accounting for tax-exempt income. But the key thing here is the trend.
Which was?
Up 9% year over year, and importantly, this marks the fifth quarter in a row of sequential NII growth. Quarter over quarter over quarter growth.
5 straight quarters. Okay, so what's fueling that consistent rise in their main profit center?
Well, it's a combination of things. They're seeing higher NII from their global markets business, just generally higher loan and deposit levels, and also what they call fixed-rate asset repricing.
Which basically means we're swapping out older, lower-yielding loans and bonds for newer ones at today's higher rates.
That's the idea, optimizing the existing book. And speaking of the book, the overall balance sheet is, well, huge and getting bigger.
How big are we talking?
Average loans and leases hit $1.15 trillion. That's up 9% year over year, and they saw growth pretty much everywhere across all the business lines.
Okay, trillion with a T. But loans need funding. Are deposits keeping up? Or are they having to borrow more expensively?
No, deposits are definitely keeping pace. Average deposits reached almost $2 trillion, $1.999 trillion, up 4% year over year. And like NII, this is the 9th straight quarter they've seen deposits grow sequentially.
9th quarter for deposits. That shows real customer loyalty, doesn't it?
It does. Plus, their liquidity position is just massive. They reported average global liquidity sources of $961 billion. So yeah, they're funding loan growth with relatively cheap deposits and still have this enormous safety net.
Nearly $1 trillion in liquidity buffer. That's got to give them confidence. Let's touch on capital and what they're doing for shareholders. How's the capital position looking?
Extremely strong. Their CET1 ratio, Common Equity Tier 1 standardized, came in at 11.6%. That's comfortably above what regulators require.
Okay, and they're putting that strength to work.
Oh, yeah. They returned $7.4 billion to shareholders just this quarter.
$7.4 billion. How did that break down? Buybacks and dividends?
Mostly buybacks. $5.3 billion went to repurchasing shares, which helps boost the EPS figure. And then $2.1 billion was paid out in common dividends.
And they bumped the dividend too, right?
They did, by 8%, which is usually a signal that management feels pretty good about future earnings.
Okay, so strong core lending, solid capital, returning cash. Let's pivot to risk. There's been this lingering worry about recession hitting loan books hard. Is that showing up in Bovica's number? Or is it actually getting better?
It looks like things are stabilizing, maybe even improving slightly. The provision for credit losses actually went down. It was $1.3 billion this quarter.
Down from what?
Down from $1.6 billion last quarter and $1.5 billion a year ago. And net charge-offs, so actual losses, also ticked down sequentially to $1.4 billion.
Okay. So the trend is favorable, at least quarter on quarter. But is it just stabilization, or are we seeing real improvement in underlying credit health?
Well, that's always the million-dollar question, isn't it? But what's encouraging is where the improvements came from. It suggests some targeted success, like consumer credit card charge-offs. The rate fell from 3.82% in Q2 down to 3.46% in Q3.
That's a decent drop for one quarter.
It is. And on the commercial side, which everyone worries about, especially commercial real estate or CRE.
Yeah, the office space concerns.
Right. Well, commercial net charge-offs decreased. And the bank specifically said it was driven by lower losses in CRE office loans. Plus, overall non-performing loans dropped by $0.6 billion. So fewer loans tipping into that serious problem category.
Okay, so maybe some breathing room on the credit side, particularly those hotspots like cards and CRE office. That's a good sign. Let's shift gears then. Beyond NII, where did the revenue really pop? Talk about the fee income side.
Right, diversification. This is where you see some real cyclical strength coming back. Let's look at global banking first. That includes investment banking,
Oh,
IB.
and that was a big story this quarter.
Huge. The segment overall had $2.1 billion in net income. But the number everyone jumped on was the investment banking fees, excluding their own deals. They hit $2.0 billion.
$2 billion. And the growth rate there was enormous, wasn't it?
43%. Up 43% year over year. That's not just growth. Feels like the M&A and capital markets engines are really firing up again.
And both have clearly caught a big wave there.
Absolutely. And even within global banking, that core deposit strength showed up too. Average deposits in that segment were up 15% year over year to $632 billion.
Okay, so IB roared back. What about trading? Global markets, how did they do?
Very consistently strong. Net income of $1.6 billion. Sales and trading revenue hit $5.4 billion, up 9% from last year. But here's the kicker.
Go on.
This was the 14th consecutive quarter where their sales and trading revenue grew year over year.
14 quarters. Straight. Through all the market chop. That's impressive consistency.
It really is. This quarter, the 9% growth came from two places mainly. Equities trading revenue was up 14%, driven by client activity. And FICC, that's fixed income, currencies, and commodities, was up 5%, mostly from better results in credit-related products.
So, strength across both stocks and bonds trading. Okay. What about the wealth management side? GWIM, Merrill, and the private bank. Markets have been generally okay, so they should benefit, right?
They definitely did. GWIM brought in $1.3 billion in net income. Revenue there climbed 10%, and that was largely driven by a 12% jump in asset management fees.
Which comes from higher market values.
Partly, yes, higher valuations helped. But importantly, it also came from strong AUM flows and new money coming in. Client balances overall reached $4.6 trillion.
$4.6 trillion.
Yeah, up 11% year over year. And they made a point of saying they're not just riding the market up. They added about 5,400 net new relationships across Merrill and the private bank during the quarter. So actively growing the client base too.
Okay, adding clients and benefiting from market lift. Makes sense. Now, let's bring this back to the efficiency story we started with and the biggest part of the bank. Consumer banking. How's the average customer doing?
Well, judging by BofA's numbers, pretty well. Consumer banking was the biggest profit generator again, $3.4 billion in net income, and that was up a hefty 28% year over year.
And are they still adding customers at that steady clip?
Seems like it. They added about 212,000 net new consumer checking accounts. And get this, that's the 27th consecutive quarter they've grown checking accounts.
27 quarters. That's almost 7 years straight of adding core customers. Incredible. Are those customers spending?
Invest. Yep. Consumer investment assets within the bank jumped 17% to $580 billion, helped by $19 billion in net client flows into those accounts. And spending on combined credit and debit cards was $245 billion for the quarter, up a solid 6%.
Okay, so the consumer looks engaged. But how does this giant consumer base connect back to that efficiency ratio, the drop to 62%? It must be digital, right?
It's absolutely central. That digital adoption story is key. They now have 49 million active digital banking users. That's up 1.4 million in a year.
49 million. That's like the population of Spain, as you said before the show.
Right. And those users are logging in a lot. 4.2 billion digital logins in the quarter, up 16%. But here's the efficiency metric. 66%, two-thirds of all consumer sales were digitally enabled.
Two-thirds done online or mobile.
Exactly. Think about what that means for costs. Fewer branch interactions, more self-service. It's why they can handle growth without expenses running wild. You see it in things like Zelle, peer-to-peer payments.
Yeah. How are those numbers looking?
Huge adoption. 24.7 million active Zelle users, up 7%. They processed 459 million transactions. That's volume up 15% with $143 billion. Dollar volume up 18%. Every one of those is cheaper than handling cash or a check.
And it's not just the mass market adopting this.
Not at all. Even among the wealthy clients, adoption is really high. 86% of Merrill Lynch and private bank clients are digitally active. It's just how banking is done now, and BofA seems to be leveraging it very effectively.
Okay, so pulling all these threads together.
Yeah.
If you had to give the listener one main takeaway from this quarter's results, what would it be?
I'd say it's about diversified strength coupled with efficiency. You've got robust earnings power across the board, lending, trading, wealth, IB booming again. You've got that incredibly stable core NII engine growing quarter after quarter. And crucially, they're managing this growth efficiently, thanks largely to that massive digital platform. It lets them capture upside, like that huge ID jump, without costs getting out of control.
It paints a very strong picture, certainly for Q3. But every silver lining has a cloud, right? Given how important NII is right now, what's the key thing listeners should keep an eye on going forward?
It really comes down to interest rates. I mean, the IB rebound is great. Credit seems okay for now, but that's strong NII growth.
Yeah.
How long can it last if the interest rate environment shifts downwards faster than expected?
You mean if the Fed starts cutting rates?
Exactly. And the bank actually gives you a hint in their own disclosures. Their sensitivity analysis estimates that if rates fell by 100 basis points, just 1%, across the board compared to current forecasts, well, that could knock about $2.2 billion off their NII over the next year.
$2 billion potential hit. Oh,
So yeah, while everything looks rosy now, that forward rate path and the Fed's actions, that's the critical factor to watch. That's probably the main potential drag on this really impressive momentum they've built.